I was asked to talk about profit inflation and firm profits. And so I'm going to do that today by talking about the recent evolution of markups in the U.S. economy, with an emphasis on what I'm going to call the early insights that we can get from the post-2019 period. Early because I'm used to having many, many years of data, not just a couple. So those early insights, but also put within a longer historical perspective. I'm going to do this by focusing exclusively on the U.S., so everything that I say is going to be about U.S. firms, and I'm also going to take a very specifically firm-level perspective. So I'm going to use firm-level data, and I'm going to describe what's happened across U.S. firms. Okay, so my sort of motivation that I'm going to start with today comes out of two things, both of which are very well known to the people in this room and which have been talked about a lot over the last couple of days, but I want to just set them up side by side as a way to sort of motivate my own remarks today. So first of all, as we know, there's been a post-COVID spike in inflation, and this inflation spike in the U.S. has come with rising profits. And so this is BA data. This is just profits, raw profits in 2017 dollars. And it goes back to about 2001. What we see in this graph is that profits ticked downwards, I would say ticked down in quarters 1 and 2 of 2020, but very quickly recovered and hit sort of new levels by 2022 and 2023. And the other point, I show this data a couple of different ways on this graph. I think really regardless of the measure, we see the same thing. The other thing that I want to sort of note here is that profits then end up at sort of a new higher level, and they've stayed there. Okay, this is just profits. I'm going to show markups in a little bit. And then that I think of as the short-term context. And then sort of what I want to do is have that short-term context against a longer-term backdrop in which there's been a long-term rise in measures of market power across firms in the U.S. economy, and together with that, a fairly substantial reorganization in how we see the corporate sector in the U.S. and how it's organized. And there's a lot of stuff that's happened and a lot of things that I could point to. I'm going to just highlight a couple of things that link the most closely to what I'm going to show you today. First of all, we see that markups and profit margins have both risen. That's also something that you all know in this room. The DeLocher et al. Paper from 2020 is perhaps the most famous in this regard, and it shows a rise in the aggregate, which means I'm going to focus on the aggregate as the sales-weighted markup. In the U.S. Economy, beginning in 1980, to reach almost 70%. So from about 20% in the 1980s to reach almost 70% by 2016. And I'm going to show you that in a couple of minutes, and I'm going to extend it up until 2022. At the same time that we've seen markups rising, we also see that top firms in the U.S. have done really well. So top firms, different ways of thinking about top firms, but top firms have made an outsized contribution to rising markups, similarly to rising profit margins. They've done so not only because their markups have risen, but also because a larger share of sales have accumulated among these top firms. So there's been a reallocation of economic activity towards these top firms, and of course, that means that there's also been a marked rise in corporate concentration in the U.S. economy as well. And then the last thing that I want to note is that at the same time that we've seen top firms doing really quite well, bottom firms have kind of been dropping out. And if we think about profits or profitability, profit rates, we see that the bottom quintile or so of U.S. corporations have actually had systematically negative and falling profits over the same period. And so sort of the story is one in which there's rising dispersion within this sector. And that's the longer term backdrop that I want to focus on. Okay, so there's been a lot of focus over the last couple of days on profit inflation. And this slide rearranged a little bit. What I want to focus on from the perspective of firms, and what I want to emphasize today is that in a period of profit inflation, and I'm going to draw on Michalis's work, the paper or the post from Nikiforos and Grote, in a period of profit inflation, we would expect to see that markups are either constant or rising. And so that would be the case despite cost shocks. What does this mean in the last couple of years? It means that in the face of the disruptions that we've seen around the pandemic and the cost shocks that we've seen, in the case that we see constant or rising markups across firms, that would show us that firms have been able to insulate themselves from those cost shocks and therefore pass them on in the economy rather than absorbing any part of those shocks. And so what I want to sort of emphasize within the longer term context is then that longer term context has arguably set that stage, right? And so rising market power after 1980 has arguably set the stage for firms' ability to pass on those cost shocks during the pandemic, and arguably has set the stage then for the inflationary response that we've seen. And as firms protect their markups, of course, there are distributional implications, and we would expect to see the burden of adjustment borne elsewhere in the economy. All right, so what does this mean for me today? Well, it means that one of the things that we need to know more about is what's happened with firm markups. Okay, and that's what I'm gonna present a number of stylized facts about today. I'm gonna show five main patterns, depending on how much time I have. I'll speed through some more than others. First of all, I'm gonna show you that in the aggregate, and again, this means the sales-weighted average across firms. I'm going to show you that firms have maintained their pre-pandemic markups in 2020, 2021, and 2022. And so this means that I'm going to show really what I would consider fairly notable stability in the markup, such that despite these large cost shocks and the disruptions that we saw around this period, firms were able to pass that on. They were unaffected, unhindered. Secondly, what I'm going to do next is I'm going to go into that aggregate, and the rest of the four things that I have on the slide are going to be different ways of deconstructing that aggregate and looking at what's going on sort of under the hood. So this is, of course, the advantage of the firm-level data. And I'm going to first focus on the reallocation effect that I mentioned a couple of minutes ago, wherein over the long term, an increasingly large share of sales has accumulated or has accrued to high markup firms. And I'm going to show that process actually reverses starting in 2020, and it reverses to a fairly substantial degree. And what it's being replaced by in order to keep that aggregate markup then stable is net entry. Third, I'm going to look at the distribution. And both my third and fourth points then are sort of getting into the distribution. And I'm going to show that despite the stability that we see in the aggregate, we nonetheless see that a long-term process wherein top firms' markups have pulled away, that the top of the distribution has pulled away, that continues in these years. And top firms continue to see this gains in their markups of a very similar magnitude to what we saw over the sort of the extended post-1980 period. And I also am going to point to some, very small in magnitude, but I think suggestive evidence that there's also a bump at the very bottom of the distribution, which I think is interesting. It's early. It's something that I would keep an eye on. I'm going to then talk about sort of that bottom. To think about the bottom a little bit more, I'm going to think about it in a different way, and I'm going to now track firms over time a little bit. And I'm going to look in particular at what happened to firms based on their pre-pandemic markups. And so if firms had a lot of market power, a high markup going into the pandemic or a lower one. And what I'm going to show, and this was surprising to me, is that the firms that were low markup in 2019 are actually the firms that seem to have the biggest gains in the post-pandemic years. And so that, again, sort of speaks to this question of bottom firms, but it looks at it in a somewhat different way. And then finally, I'm going to say a couple of things about sector. I'm going to draw on Isabella Weber and co-authors' work here, and I'm going to look at systemically important sectors by her definitions and non-systemically important sectors. And I'm going to show that some systemically important industries have played in the aggregate, both because of their size and because of the level of their markups, have worked to push up the aggregate markup in these immediate post-pandemic years, but that there's also evidence in both 21 and 22 of rising markups now only within the downstream sectors. So firms that are in these quote-unquote downstream sectors, their markups also now appear to be rising as well. And so that's some evidence, I think, of that propagation mechanism. Okay, so my main takeaways that I want to kind of back out of here. I'm going to argue that this evidence suggests that firms have really been able to exercise this long-term gain in markups so as to be able to pass on rather than absorb cost shocks. And I also want to reiterate that there is some early evidence that bottom firms have had a new ability to perhaps take advantage of the confusion of this period in order to raise markups in a way that they had not previously been able to do. And also that there's been some spread now into these so-called downstream sectors. Okay, so I'm going to use CompuStat data, which is firm data for the US. I have it from 1950 through 2022. The 2022 data is, I think, almost complete, but it is still possible that a few firms are coming in. I've downloaded this fairly recently, but I do want to raise that caveat. And I'm going to talk today about listed U.S. non-financial firms, and this is important for what I'm going to show. So I focus on non-financial firms, so I'm excluding finance from everything that I'm going to talk about today. It's listed firms. That's a feature of firm-level data. Those are the firms that I can get information on. That's a very sizable and macroeconomically relevant part of the U.S. economy, so I think it's an interesting set. I think what's most important for me to note is that I'm going to talk about U.S. firms, and what this means is that I'm going to exclude a set of firms that are in the CompuStat database that are foreign private issuers. So foreign private issuers are firms that list on U.S. or foreign stock exchanges to get access to international equity markets. And this is going to make a qualitative difference in what I show you, and that's why I'm emphasizing it here. These are not firms that need to do business in the U.S. in any way. Okay, and this is notable in the post-1980 period. The share of foreign private issuers has gotten really quite substantial, which makes sense with globalization of international finance, right? And foreign private issuers are actually about a third of the sample by the 2010s. So those are all going to be excluded from my analysis as well. I'm going to measure the markup as a measure of the markup over the cost of goods sold. I'm going to show one markup today for sort of ease of exposition. This is going to basically follow the Gil-Tertre et al. Paper, but I am using the constant elasticity version. So what this means is that I'm able to speak to the literature and to the other empirical papers that are also listed here that have been looking at markups. I'm extending something that we've seen, but the specific definition of the markup that I'm using is not driving the results that I'm showing you. All right, so this is my first main trend. This is my aggregate markup, the sales-weighted markup across U.S.-listed non-financial firms from 1950 through 2022. And the long-term trend is one that we know very well, right? The long-term trend from the Gil-Tertre et al. Paper goes up until 2016, which is right when the series kind of levels off, okay? So if you're trying to count backwards, that's 2016 up there. And so the long-term pattern is one in which we've seen that markups have risen, particularly in the 80s and the 2010s, really quite rapidly. And there's been this long-term trend that we know about that's not new, wherein that aggregate markup in the U.S. economy is simply much higher than it used to be in the early 1980s. Okay. Now, if we look at those the early evidence, the pandemic post 2019 years, what we see then is that the aggregate markup is quite stable. And again, what this means to me is that firms have been able to exercise a remarkable amount of price-setting power in order to completely insulate themselves from the shocks that they've seen. It hasn't caused any changes in that markup. All right, now, since those of you who are following this will notice that I'm showing you something different here than what you've seen before, and that you might have seen evidence that the markup is actually rising in 20 and 21. And so I just want to show you that the bulk of the reason that my series looks different, that the real reason it looks different is that I exclude those foreign private issuers. So in the red line is exactly what I showed you on the previous slide. The black line now is a sort of a larger CompuStat sample that includes foreign private issuers, and it's the sales weighted average across that bigger sample of US and non-US firms. And in that version, you see that the two series track really well most of the period. They end up at a very similar level by 21 and 22. The only sort of the only kink is that they behave differently actually in the years that I'm most interested in today. And so that black series is where you see that the markup rose really to a quite substantial degree in 21 in particular. And so I do want to point that out in case any of you are looking at that graph and saying that's not what I've seen before. Okay. All right, so what I'm going to do then with the rest of my time is disaggregate this series. And again, what I want to do is I want to say, okay, we have this aggregate trend. In the aggregate, that markup appears to be constant. What's going on under the hood? Okay, what can we learn underneath? And so the first thing that I'm going to focus on is that reallocation effect that we had been seeing dominate the rise in the markup, and I'm going to show you the data in a second for most of this period. So, of course, if I'm looking at a sales weighted average, a weighted average, that weighted average can rise for different reasons, right? It can rise because markups within firms go up. That would be one reason that it might rise. It can also rise because the weights change. So because there's a reallocation of economic activity, specifically sales, towards high markup firms. And that is what had been driving the trend in the most recent couple of decades. And it could also reflect entry and exit. So the entry of higher markup firms or the exit of relatively low markup firms. Okay, so I'm going to show you that decomposition now. And I'm only showing it to begin up until 2020. So I've excluded the last couple of years at first from this graph. And the red line across all of my slides is showing you that same aggregate trend that I showed you on the previous slide. That's not changing. And then what I do here is I decompose that aggregate trend into these three components. I have the within firm component, I have a reallocation or a market share component, and I have the role of net entry. And in each case, what I'm plotting is a counterfactual series that shows us how that markup, aggregate markup, would have evolved if, for example, I only allowed within firm changes in the markup. That's the blue line. Or if I only allowed the sales shares of firms to change and I kept the within firm markups constant. That's my black line. Or third, if I only allowed net entry. Okay? And so over the long run, we see that, first of all, up until about 2000, both that market share, that reallocation component, and that within firm component are important, right? That if, for example, we only allowed within firm changes in markups, the markup would have increased from about 20% to just over 30% in the aggregate over this period. If we only allowed a reallocation of sales, the reallocation of sales to happen, we would have seen a similar change. And then since about the early to mid 2000s, really that reallocation or that market share effect takes off, and the series is really largely, the aggregate pattern that we see is really largely driven by the fact that there's an agglomeration of sales among high markup firms. Okay, net entry on a year-to-year basis doesn't make much of a difference, and I don't think that's very surprising. Okay, so now what I'm going to do is I'm going to add the 21 and 22 data. And what I want to highlight here, and again, this is just a couple of years of data, so it's suggestive as to whether this turns out to be a sustained trend or not. But that reallocation effect declines. And so what this means is that really for the first time over this series, what we're seeing is that the sales share of high markup firms is no longer rising, and in fact that's reversed. So if we only took the changes in the sales weights into account, the aggregate markup would have fallen in the last couple of years. Why has it not fallen? Well, it's not fallen because net entry has replaced it. That's what generates that stability. I'm going to be very careful about interpreting net entry with such a short amount of data, but I would say that the early evidence suggests that that's the entry of relatively higher markup firms. Okay? All right. Now, if I turn to the distribution, so again, I want to unpack that series in different ways. The red line still shows the sales weighted average as it has on all of the previous slides. My scale is different, so the trend is masked a little bit now. What this graph is showing then is the 90th percentile, the 75th, the median, the 25th, and the 10th percentiles of that distribution. The long-term trend here, as with all of the long-term trends I'm showing, are things that have been well established. And so the long-term trend is one in which we see that the aggregate markup rises during a period at which the top really takes off, right? And so that 90th percentile more than dominates the trend that we see. You see some growth at the 75th percentile over the long term as well. Once you get to the median, really nothing is happening, okay? Now, again, with 2 years of data, what do we see? We see that despite the fact that the aggregate markup is really stable over these last couple of years, top firms, that 90th percentile, the trend in my interpretation continues really relatively unabated. So in both 20 and in 21, we see that the markup at that 90th percentile does go up. So there is something else happening within that sector, right? In 21 to 22, it's pretty constant, but that happens at many other years along the long-term trend as well. And so these are magnitudes of changes that look a lot like what we've seen before. I think that without knowing something else happened, I would say there's no blip. That's a trend that continues as it used to. Across the distribution, markups are pretty stable then, like they are in the aggregate. The only thing that I do want to note, without over-interpreting a small change, is that at the 10th percentile, we see that markups dropped and they recovered. That increase that we see at the 10th percentile, it's small in absolute magnitude, but it's really quite large relative to the markup at that quantile, and that's something that we didn't see at other percentiles or other years. Okay, so I do want to sort of raise the question of if there's some suggestive evidence of something new happening at the very bottom as well. Okay, I'm gonna now, I have two more things that I want to show, and I think I probably have like 7 minutes. So I want to get to that prior market power question just a little bit, because what I showed you in the distribution, these are cross sections over time, and so firms can jump from one place to another. There's no reason that we should think that the same firm is hanging out at the same place in all years. And so what I'm going to do is I'm going to just sort of as a very rough step, and this is corroborated by other sorts of evidence, but I'm going to show you one thing. I'm going to ask the question of the role of prior markups in post-2020 firm behavior. And so what I'm going to do here is I'm going to track firms over time instead of allowing them to jump. I'm going to rank them by their pre-pandemic markups. I do this based on 2019. That specific choice on 2019 markups does not matter very much. I could do 2018 and 19. I can move that around. But the main idea is that I want to classify a firm as having a low or high markup and make it stick, right? Stick in that group. Okay, and when I do this, then I can track those firms moving forward, and I'm going to talk about these graphs in a second. But the early evidence suggests to me that something again is happening at the bottom, which looks different than what we've seen before. And again, I think this is indicative of the possibility that the confusion of this period let bottom firms do something that they hadn't been able to do. So on the left, I'm showing this in levels, and the levels are so dramatically different of top and bottom firms that it's almost uninteresting. But I wanted to sort of send home how different those levels are. So the red line shows the average markup among the top 10% of firms ranked by their 2019 markup. Okay? The blue line at the bottom shows that average markup among the bottom 10% of firms, again ranked by their 2019 markup. So what do we see? We see that all of the action is at the top. That's something we knew over the long term, right? We see that not only are top firms sort of top in 2019, but their markups have been rising for some time, with the caveat that my sample changes as I move, I lose firms the further I go back in time. But they've been, that group has been sort of amassing these higher markups for a while now. That's not something new. There's some stability. But if we look at the most recent years, that trend seems to have actually reversed a bit. And in contrast, if we look at the bottom, and again, the levels are so small at the bottom, it's hard to see at first on the left, but we see some growth among the firms that went into the pandemic with the lowest markups. So I then index that on the right-hand side so that we can just compare the magnitudes of changes. Okay, and what that shows is that in that bottom 10%, there's about a 10% increase in the markup in those years. Again, just a couple of years of data. I don't know, maybe it will reverse completely, but it is something that I want to suggest. Okay, so my last thing. is to talk a little bit about sector. So sector has gotten a lot of attention in all of the discussions about firms and inflation in the last couple of years. One thing that we know is that over the long term, that long-term trend in the markup is driven by within sector changes. Okay, so it's not a structural change effect. It's not the case that high markup sectors have grown in the US economy and low markup sectors have shrank. Instead, it's a very broad-based trend wherein we see markup growth happening within most industries. Okay, so that's the long-term pattern. What happens in the recent years? Well, after 2019, markup growth is concentrated in these systemically important industries. And again, I'm using a specific definition of systemically important. I'm going to show you the industries in a second. It's a more useful way to summarize the data than like 2-digit NAICS codes or 3-digit NAICS codes. It produces patterns that are more informative. I'm going to start by showing one table, and then I'm going to show you some bar graphs. So what I'm showing you here is the total contribution of systemically important, all the firms in systemically important industries, and all the firms in non-systemically important industries, to the aggregate markup, to the change in the aggregate markup in 2019, 2020, 21, and 22. And as the third column here shows you, or reminds us, there's really no change in the aggregate markup in these years. So I'm not trying to explain a change. I'm trying to understand what's going on, if there's patterns going on underneath that change, showing divergent experiences. The two boxes that are kind of highlighted in blue are showing the total contribution of systemically important sectors to the aggregate markup in these years. This is their total contribution. It includes both changes in their size and changes in their markups, okay? And what it's showing is that in 21 and 22, systemically important industries made a very substantial positive contribution to the aggregate markup. And that's being offset, of course, then, because it's relatively stable in the aggregate, by a decline in those non-systemically important industries. I'm going to, again, show you these in a second, what they are. In terms of magnitudes, the magnitudes are, again, a little hard, I think, to interpret because I'm looking at annual changes in a period where there isn't an annual change, right? But if we're thinking about a 3 or a 2 percentage point change in the contribution of these systemically important industries, that is very big. Put up against that long-term trend. So if we are to rank the post-1980 changes in the markup, in the aggregate markup, this is among the top changes that you would see. These are big contributions. Okay? All right. What industries are these? I know I have more information on this slide than I should. I'm just going to talk about the two bottom graphs. So this is now showing you the contributions of different systemically important industries in 2021 and 2022. And we have petroleum and coal at the top and oil and gas as the two top industries. And then at the bottom, I have all other firms grouped together as non-systemically important industries. And so what this shows is that the action, and this goes back to the discussion on the first evening as well, the action is really in two of the systemically important industries. These are petroleum and coal and oil and gas. Okay? And what we see at the same time is that the non-systemically important industries are putting downward pressure on that aggregate markup. Okay? Okay, again, I have one more thing to show. Again, remember that these are the total contribution. So I'm sort of, in each of these bars, I'm combining a size effect and a within markup, within change, okay? And so the last thing I'm going to do is I'm going to distinguish those two effects. I want to do this in 2 steps so that it's kind of easier to see the pieces, okay? So again, I'm going to start just about the bottom 2 graphs. So I have the within sector change is now being shown in blue. The between sector change, so this is the sector getting bigger or smaller, right? That's being shown in red, all right? And we see that with the exception of oil and gas in 2021, again, focusing on those 2 most recent years, the contribution of these systemically important sectors is primarily coming from the fact that these sectors are getting bigger. Okay? This is not actually a within sector markup change that's driving that total contribution. Okay? These sectors are getting bigger. Now, this is where the non-systemically important industries also get interesting. So if we look now at 2020, and you look just at the bottom bars of my 2020 graph, which are my non-systemically important firms, we see that in 2020, The within component is negative. Markups are falling in 2020 within these firms. And now if we look at 2021 and 2022, we see that while these industries, these firms and these industries together pull down the aggregate markup, that's because they're shrinking, okay? And within sector markup changes in both are positive. And again, I would note the magnitudes are not economically insignificant. These are meaningful magnitudes. Okay, so 1 minute, perfect. All right, I have 1 minute. All right, so what are my conclusions? Firm markups arguably point to provide evidence of profit inflation. And here, what I really, again, want to sort of tie all the way back to is that the aggregate markup is steady. And this shows that firms were able to insulate themselves from these shocks. I show that despite the steady markup, there's interesting stuff going on within the sector. So the sector looks different than it did before. And I think that with that reallocation effect shrinking, there's arguably some evidence of sort of broader-based changes, broader-based expansion of markups going on. Looking forward, I just want to sort of note 3 things on my way out. I think this preliminary early evidence about bottom firms to me raises the question of sort of competitive questions and the possibility that perhaps low markup firms were able to do something they hadn't done before, and maybe that means taking advantage of confusion in this period to raise prices a bit. And then I also want to emphasize that markups within these non-systemically important sectors do rise in both 21 and 22. And so I think then, like, my last question that I would leave with is this question of whether those increases in markups would be returned when the period of disruption ends, or if in line with history that would be sort of a permanent effect. Thank you.